Okay, so we are now going to start discussing about this December 2016 exam question, which is question number 1. The name of the question is ZCG, the Z Communication Group. This is Z Communication Group is actually one of those exam questions, which is going to be our last question pertaining to the audit risk that we have discussed up till now. So basically, this is what it is going to be. Okay, so ZCG is an audit client of your firm, Tarantino & Co. with a financial year ending 31st December 2016. What exactly are the requirements of the question? So there are various requirements of the question and we'll try to attempt each requirement. It says evaluate the audit risk relevant to planning the final audit of ZCG. Further, it says discuss the matters to be considered in determining the assistance which could be provided and the amount of reliance, if any, which could be placed on internal audit department. The principal audit procedures to be performed on classification of 50% equity shareholding in WTC as a joint venture, and the measurement of the intangible asset recognized in respect of license to operate in Florida. So let's try to have a quick read of the question and then we shall start discussing. Okay, let's start discussing about it. So if I start discussing about this question, the first thing is it says the Z Communication Group is an audit client of your firm, Tarantino, with a financial year ending 31st December 2016. You are a manager assigned to the forthcoming audit. ZCG is a listed entity, one of the largest telecommunications provider in the country, and is seeking to expand internationally. ZCG also provides broadband and fixed telephone line services. It says you have just received the following email from audit engagement partner. Now, what exactly is that? We need to begin planning the final audit of ZCG, which, as you know, is one of our largest audit clients. I met with the group's finance director yesterday and I have provided you with notes from this meeting along with extracts from the latest management accounts. We have also discussed the possibility of using the group's internal audit team to improve audit efficiency. I have provided you with extracts from latest report of internal audit department. Using all the information, you are required to prepare briefing notes for my use in which you evaluate the auditor. Now, it says that the audit risks need to be planned. Now, see, it says one of the ZCG's strategic aim is to expand internationally, either by acquiring existing telecommunication providers in other countries or by purchasing license to operate in foreign countries. Remember, we have talked earlier also that whenever we talk about audit risk, you always have to focus upon what could go wrong. You always have to focus upon what could go wrong. Now let's see. It says in March 16, ZCG purchased a 50% equity shareholding in WTC, a company operating in several countries where ZCG has previously no interest. The other 50% is held by Wolf Communication Company. The cost of 50% holding is 45 million. It is planning to account for its investment in WTC as a joint venture in the group financial statement. So remember, what happens is you could actually have this one specific risk, which is about the classification of investment. The classification of investment as one of the risks. What could happen is the classification of investment could be considered as one of the risks. Now, what else is there? It says on 1st January 15, ZCG purchased a license to operate in farmland, a rapidly expanding economy at a cost of 65 million. I'm going to draft the answer to this, but first of all, I'm just identifying that what exactly are the risks. So it says in 1st January 2015, ZCG purchased a license to operate in farmland, a rapidly expanding economy at a cost of 65 million. The license lasts for 10 years from the date it was purchased. Since purchasing the license, ZCG has established its network coverage in farmland, and the network became operational on 1st July 2016. The license was recognized as an intangible at a cost. Since network became operational, customer demand has been less than anticipated due to a competitor offering a special deal to its existing customer to encourage them not to change the provider. So this is basically, this is an indication of impairment. This is basically one of the indication of impairment. Now what else is there? It says most of ZCG's mobile phone customers sign a contract under which they pay a fixed amount each month to use the ZCG's mobile network. Now, the next thing is, it says most of ZCG's mobile phone customers sign a contract under which they pay a fixed amount each month to use ZCG's mobile network, paying extra if they exceed the agreed data usage and airtime limits. The contract also allows connection to a fixed landline and internet access using broadband connection, and most contracts run for 2 or 3 years. For the first time this year, the group is adopting IFRS 15. So basically, another risk that could arise is with respect to revenue recognition. Another risk that could arise is with respect to revenue recognition and the application of IFRS 15. It says, in order to extend its broadband services, ZCG has started to purchase network capacity from third-party companies. ZCG enters into a fixed-term contract to use a specified amount of seller's network capacity, with seller determining which of the assets are used by ZCG in supplying network services to its customer. In the first 6 months of 2016, ZCG purchased 17.8 million of network capacity from a range of suppliers, with the contract periods varying from 12 months to 3 years. The cost has been capitalized as an intangible asset. Now what happens is that ZCG has started to purchase network capacity from third-party companies, and it enters into a fixed-term contract to use a specified amount of seller's network capacity. The seller determines which network are going to be used. So in first 6 months, it purchased 17.8 of network capacity. So we need to see the policy of capitalizing it as an intangible, and at the same time the amortization policy that actually needs to be followed with respect to it. It says ZCG has a well-established internal audit department which is tasked with a range of activities, including providing assurance to management over internal control and assisting the group's management team. The internal audit department is managed by Jules Winfield, a qualified accountant with many years' experience. An extract from executive summary of the latest internal audit report is shown below. It says, we are pleased to report that ZCG's internal controls are working well, and there have been no significant changes to systems and controls during the year. As a result of our testing of controls, we uncovered only 2 financial irregularities which related to failure to obtain appropriate authorization and approval of senior management expense claims, such as travel and other reimbursements. The unsubstantiated expense claim amounts to 575,000. The second is inadequate. So there could actually be weak internal controls. That could be one of the things. There could be weak internal controls. That could be one of the things. Now what else is it? It says finance information extract from latest management accounts. So 8 months to 31st August 2016 and 31st December 2015. Since this company, which is ZCG, which is a listed entity and it is operating in multiple countries. So there is another important thing that we need to identify, and that is basically the operating segments, which is the IFRS 8. That could also be one of the risks, that the appropriate disclosures are not provided, etc., etc. So we have been given these various revenues from the various countries, etc. Then we have been given the total assets, etc. And we need to respond to the engagement partner's email. Now what I would do is that I would try to actually write down the draft the answers to these various audit risks that are being mentioned in this specific question. So if I talk about this December 2017 ZCG, the first part, which is actually about the audit risk. The first part, which is about audit risk. Okay, now if I talk about the various audit risks that are being faced by this company, so number one of them is IFRS 8 operating segments. Entity operates in multiple countries and is a listed entity. A listed company is required to follow requirements of IFRS 8 operating segments. There is a risk that appropriate disclosures relating to IFRS 8 operating segments are not provided, resulting in misstatement of notes to the financial statements. Now what else is there? So that's the number one thing, which is IFRS 8 operating segments. The second risk pertaining to this company was actually about the classification. So what happens is the classification and accounting for investment in WTC. In case entity has acquired 50% holding in WTC, and in case, and it is important to ascertain if this shareholding provides entity with control or joint control or significant influence. So it says entity is acquired. I mean, we need to identify that 50% holding in WTC is acquired. So now, in case if joint control is exercised on WTC, now what exactly do you mean by exercising the joint control on WTC? The exercising of the joint control on WTC is basically going to be like this, that both the ventures consent is obtained before taking any decision, before taking any relevant decision, then such entity is to be accounted for as a joint venture and accounted for using equity method of accounting under IAS 28. So what exactly is the risk? The risk is that entity may not exercise joint control, and result in this may result in incorrect classification and hence accounting of the incorrect classification and hence accounting of the WTC, of the investment in WTC. So this is what you will actually identify, that this is what another risk is. So we have identified two risks. One of them is basically about the classification, one of them is about the operating segment. Then you've got this license to operate in fast and a rapidly expanding economy. And then you have got another competitor who's not actually letting you operate in a free will. So the third risk in this specific question is going to be, we'll talk about the valuation / carrying amount of the license. So investment, so basically the license, useful life, then impairment testing. So these are the various things, that the license, the impairment testing because of the competitors reaction to our entry. So this is what it is going to be, another area of risk. What is the fourth area of the risk? Let's try to understand that. The fourth area of the risk is basically going to be the revenue recognition criteria, because what happens is you cannot recognize the entire revenue immediately. So revenue recognition could also be another risk. The revenue recognition could also be a risk. Now what is going to be the risk pertaining to this revenue recognition? So it's actually going to be, one of the things is going to be that the IFRS 15 application, lack of understanding, lack of expertise, and incorrect application to the business model. Revenue received in advance, recognized before being earned, resulting in overstatement of sales and profits. So these are the various risks pertaining to this revenue recognition. Now what else is there? The next situation is, we've also identified that the network capacity that we have purchased. Well, you could just mention that what should have been the correct treatment, and you're fearing that the correct treatment may not have been followed. Don't go for the exam answers. Okay, so this is what we have established. Now what next is there? So this network capacity from third party, you enter into a fixed term contract to use a specified amount of seller's network capacity, with the seller determining which of the network assets are used by ZCG in supplying network services to its customers. So it says in the first 6 months of 2016, ZCG purchased 17.8 million of network capacity from a range of suppliers with contract periods varying from 12 months to 3 years. So the contract period will be varying from 12 months to 3 years. Now what else is going to be there? It says the cost has been capitalized as an intangible asset. Now let's try to understand, let's try to. So basically what happens is the network capacity. What is the next thing? The network capacity. License to use network capacity. License to use network capacity. Now when we talk about the license to use network capacity, how exactly are things gonna operate? So when we are actually gonna talk about the things operating, so let's talk and let's discuss about it. It says the license to use network capacity is going to be like this. We'll talk about them to be that the recognition of the cost to operate as intangible. Does it meet the criteria? Policy of amortizing it. So recognition of the cost to operate as an intangible, does it meet the criteria? Policy of amortizing it. So is the carrying amount appropriate? So these are the various risks that are actually there when we talk about this network capacity. Now what else is there? The other risk that we have is basically about the internal audit department, that there have been evidences of the two financial irregularities that have been found. Number one of them is failure to obtain appropriate authorization. The unsubstantiated expense claims amount of this. Inadequate access over the group's IT system resulted in payroll fraud amounting to this. So another thing is basically the sixth point is the weak internal controls or the control risk. So what is going to be the control risk? The weak internal controls prevail in the entity, and such weak controls. So what does it mention? It says weak internal controls prevail in the entity, and such weak controls So it says weak internal controls prevent in the entity, and such weak controls can result in misstatement of multiple items carried in the financial statement. So these control risks can have an impact of multiple items carried in the financial statement. So this is what another risk is. So basically when we come across this requirement of audit risk, so this is what we are going to do with respect to this audit risk relevant to the planning of the final audit of the ZCG. One more thing that I would want to highlight is that we were being given the total sales of the company, 198 and then 220. So what we could do is that probably we could use the numbers that are being given to us. We could compare them to the total asset balance. We could compare them to the total sales to establish the level of materiality. That's what we could do. Compare them to the total sales, compare them to the total amounts to establish the materiality level. So that is, we are done with one of the parts of this question that was about the audit risk. Now, it says discuss the matters to be considered in determining the assistance which could be provided by and the amount of reliance, if any, which can be placed on the work of ZCG's internal audit department. So basically what happens is, when we talk about this is actually a textbook item, which is ISA 610. This is majorly about ISA 610, which is placing reliance on the work of internal auditors. So it's actually placing reliance on the work of internal auditors. That is what ISA 610 is all about. So this is more of a textbook item, which is placing reliance on the work of internal auditors. And I can't actually, I mean, there is not something that is going to be different that I could teach except for what is mentioned even in the past paper answer. So I would suggest that this answer to this part should be seen from the past papers, because that's going to be the best coverage of the issues that needs to be covered while placing reliance on the work of internal auditor. Lastly, it says, recommend the principal audit procedures to be performed on classification of the 50% equity shareholding on WTC as a joint venture, and no, not necessary to mention either code, and the measurement of intangible recognized. So what is the basically principal audit procedure? Important thing is you need to highlight and you need to identify that what exactly is the examiner asking. He is saying classification of the 50% equity shareholding in WTC. It's the classification of the 50% equity shareholding in WTC as a joint venture. Now that's what we have to focus upon. So let's try to understand, let's try to calculate this. So basically what happens is, if I talk about this, now see, classification is what we have to talk about. Now, how would you actually go about classification and the relevant audit procedure? Because a lot of the students, they actually get stuck in performing the audit procedure. So I'm going to talk about how the audit procedures are performed. So I'm going to talk about it. Number one of them is the classification of investment as joint venture. So basically what happens is, always remember that the audit procedures are derived from the risk, because risk is what could go wrong. Risk is what could go wrong. And the audit procedure is action taken by auditor to confirm or check if something gone wrong. So what is the difference between this risk and the procedure? Basically, first thing is you need to identify what is the risk in the scenario. Once you know the risk, then you can actually identify your procedure. So basically, if I talk about the various risks pertaining to it, the problem is the classification. Now, my point is that if I need to draft the audit procedure, how would I actually get to know if the classification is correct or not? So it's actually about the shareholding. It's actually about the agreement. It's actually about the board minutes, which actually would indicate that who is taking the decision making power, and management's written representation. So basically what happens is, what are going to be the audit procedures? The audit procedures are going to be the actions that we would take as an audit. The first thing, the second thing, the third thing, and the fourth thing. Now what is actually going to be this audit procedure? The first thing about this audit procedure is going to be, we say that we'll inspect the shareholder register to confirm that ZCG owns 50% of the shares in WTC. Inspect the share purchase agreement to confirm the terms under which these shares have been acquired. Inspect board minutes to assess how the decisions pertaining to the operations of WTC are taken. And lastly, what happens is, obtain management's written representation confirming that they exercise joint control over WTC. So basically the examiner had asked us about the classification. He had not asked us about anything else except for the classification. So what we did was, we actually focused upon classification. We focused upon classification only. Now, what is the last requirement of the question? The last requirement of the question is basically, it says measurement of intangible assets recognized in respect of license to operate in foreign. So it's about measurement. License to operate in foreign land, that's what the measurement is going to be. Now, so what exactly are going to be the risks pertaining to this measurement of the license? So other area is going to be the measurement of the license for the operations in the far end. Now what next is it? So basically, let's try to identify the various risks, because once we have the risk, then we could actually talk about it. So the cost could be one of the factors. The second thing is basically the license lasts for 10 years. The duration of the license, the life of license, and the next situation is basically, so it's actually the license's life, and the next thing is the next thing is the operational date, the date of operations, operational date of license. The next thing is the impairment testing. The next thing is the impairment testing. So that is what it is. So this is what the various risks of the licenses are. So we would actually have our audit procedures, keeping in mind these specific things that we need to verify, that we need to confirm, or the things that we think that may actually have a problem. So inspect the agreement to purchase license to confirm cost and term of license. So this is what you need to do. You need to inspect the agreement to purchase license to confirm the cost and the term of the license. The next situation is that we would trace the payment made for the license to the bank statement. We'll trace the payment made for the license to the bank statement to confirm that payment amount is, to confirm that cost is correct. The third thing is that recalculate the amortization, or inspect the documents, or basically inspect the operational logs of entity to confirm the operation starting date. The fourth thing is that recalculate amortization expense of the license recognized in P&L. The fifth aspect is basically test assumptions used for the calculation of value in use of license. Test discount rate used for license value in use for reasonableness. So these are the various things that you could do with respect to the licenses measurement of the carrying amount in the balance sheet, that if the license is being carried at the correct amount or not. So that is what you can actually do. So that is what you can actually do. So basically, I hope that this is clear to everybody. This is how you actually draft the audit procedure, that you identify the risk, and then you actually perform the procedures accordingly.